2024 will go down in history as the year of Bitcoin and the triumph of the spot ETFs. 2025 was the period when institutional giants started cautiously testing the waters with altcoins. But look at the calendar. It is January 2026, and this year already promises to be the single greatest turning point in the history of the crypto industry. It is the year when Ethereum's seemingly unshakable status as the world computer faces its most serious threat in a decade. We are accustomed to repeating the mantra, Bitcoin is digital gold, Ethereum is digital oil. But let's put emotions aside and look at the cold, hard reality. While Ethereum spent years transitioning to a complex modular architecture, confusing users with dozens of Layer 2 networks, Solana silently built a monolithic monster. And right now, as you listen to this, the center of financial gravity is shifting. Let's start with the numbers, because a blockchain is, first and foremost, a database, and metrics don't lie. Take a look at trading volumes on decentralized exchanges. 2 years ago, Ethereum dominated with a 70% market share. Today, in early 2026, we see days, and even weeks, where the trading volume on Solana, via Jupiter, Radium, and Orca, exceeds the combined volume of the entire Ethereum mainnet. We are talking about numbers that regularly break the barrier of $3, sometimes $5 billion in daily volume. This isn't just a spike. This is a structural shift in liquidity. Why is this happening? The answer lies in liquidity fragmentation. Ethereum chose the path of scaling via Layer 2 solutions, Arbitrum, Optimism, Base, ZK Sync. This created a feudal fragmentation. Imagine having dollars in New York that aren't accepted in Chicago without paying a middleman fee. The Ethereum user experience in 2026 feels like trying to take a train with 3 transfers just to go one stop. Users are tired of bridges, tired of bridge hacks, and tired of managing gas tokens across 5 different networks. Solana offered the market what we call monolithic architecture, one global state, one unified order book, and the market voted with its feet. The number of daily active addresses on Solana reaches 5 to 7 million during peak moments. For comparison, Ethereum, even combining all its L2s, often shows numbers 10 times lower. We are witnessing not just a competition of technologies, but a competition of philosophies. And right now, the philosophy of speed and convenience is beating the philosophy of complex decentralization. But the main price catalyst for this year isn't technology, it's regulation. The holy grail of the crypto market, the ETF. After the approval of Bitcoin and Ether funds, a Solana ETF is no longer a question of if, but when. Asset management giants, Van Eck, 21 shares, and rumors suggest even heavyweights like BlackRock have already prepared the ground. Why is this so critical specifically for Solana? It is pure math. Bitcoin's market cap is measured in trillions. To move its price by 10%, you need inflows of hundreds of billions. Solana's market cap, for all its power, is still a fraction of that. This means that the same volume of institutional money, say $5 or $10 billion of net inflow in the first year, will trigger a multiplier effect capable of sending the price vertical. Wall Street investors are looking for tech beta. They don't need a second digital gold. They need an early-stage equivalent of Apple or Google stock, and Solana fits this narrative perfectly. Now, let's talk about the secret weapon that changes the game completely. Its name is Firedancer. For a long time, critics rightly pointed out Solana's instability. The network is down, they said. And they were right. But Firedancer is a new validator client built from scratch by high-frequency trading engineers at Jump Crypto. In 2026, Firedancer moved from the test phase to battle mode. What does this give us? A theoretical ceiling of 1 million transactions per second. But even in practice, we are talking about throughput that exceeds Visa's payment system by dozens of times. Network latency, or ping, has dropped to milliseconds. This opens the doors for players who previously wouldn't even look at blockchain, traditional exchanges, global logistics systems, and high-frequency trading algorithms. Ethereum, with its 12-second block time, is physically unfit for such tasks. This brings us to the hottest trend of 2026, the convergence of AI and crypto. AI agents, autonomous bots that trade, gather data, and interact with each other. They need a habitat. An AI agent executes thousands of microtransactions per day. If it tried to do this on Ethereum, it would go bankrupt on gas fees within an hour. On Solana, where transaction costs are fractions of a cent, these agents can live and thrive. Projects like Render Network, IO.net, and Grass, which focus on decentralized compute and data scraping for AI, are mass migrating to Solana's infrastructure. We are seeing the birth of a new economy, the machine-to-machine economy, an economy where machines pay machines, and the currency of this economy is SOL. We cannot ignore the consumer sector. Solana is the only blockchain that has successfully bridged into the physical world. The launch of the second smartphone, the Solana Seeker, proved that the demand for crypto-native devices is massive. Pre-orders exceeded 150,000 units before launch. This creates a unique defensive moat. No other blockchain has its own army of users carrying a hardware wallet built directly into their phone, with an app store free from Google and Apple's censorship. This is direct access to the consumer, bypassing the Web2 corporations. However, there is no such thing as a free lunch. I have to tell you about the risks to keep this review objective. First, the economic model, inflation. Solana pays validators with new tokens. Yes, inflation is programmed to decrease, aiming for 1.5% long-term, but right now, the market is still absorbing millions of new coins every month. This creates constant sell pressure that must be met with new demand. Second, the shadow of FTX. Although years have passed since Sam Bankman-Fried's exchange collapsed, the asset liquidation process is a long story. Huge bags of SOL, locked with bankruptcy trustees, continue to gradually thaw. Galaxy Digital is managing these sales carefully, via OTC deals to avoid crashing the order book, but the very existence of this overhang keeps many conservative investors at bay. And the third risk, validator centralization. Solana's Nakamoto coefficient is rising, and the network is becoming more distributed, but the hardware requirements to run a node remain extremely high. You cannot run a Solana node on a laptop in your bedroom. This is the domain of professional data centers. For crypto purists, this is a red flag. But for the mass user, it is an acceptable compromise for speed. To wrap this up, we are at a bifurcation point. The scenario where Ethereum loses its dominance is no longer science fiction. It doesn't mean ETH will disappear. It will likely occupy the niche of an ultra-reliable, expensive settlement layer for interbank transactions and large capital. A blockchain for the elite. But Solana is aggressively taking everything else. Gaming, micropayments, social networks, DePIN, AI, and meme coins, the entire living, breathing economy is flowing to where it is faster and cheaper. If you are betting that 100 million new people will enter crypto in 2026, you have to understand, they won't pay $5 per transaction. They will go where the interface feels like Instagram or Revolut. And right now, only one network can deliver that experience at scale. The market is awaiting ETF approval. Firedancer is revving the engine to supersonic speeds. The ecosystem is blooming. The risks exist, but the potential risk-reward ratio looks like one of the most attractive plays in the market. The battle for 2026 has begun, and perhaps the winner has already been decided. The only question is, are you ready to accept this new reality?